When a company rents a piece of equipment for most of its useful life, they essentially control it as if they bought it outright. Under International Financial Reporting Standards, IFRS, that level of control requires the lease to be capitalized and placed directly onto the balance sheet. The standard rule is precise. The lessee must record a right-of-use asset and a matching lease liability. Both figures are calculated based on the present value of the future lease payments. Take a basic 3-year lease. The company pays $10,000 at the end of each year, and the implicit interest rate is 5%. Plugging those variables into an ordinary annuity formula yields a present value of $27,232. To record this on day 0, we set up the initial journal entry by debiting the right-of-use asset and crediting the lease liability for that exact starting amount. In a basic scenario with no extra costs, the asset and the liability are perfectly symmetrical the moment the contract is signed. Let's adjust the terms. Instead of paying at the end of the year, the $10,000 payments happen at the beginning of the year. The company also pays a $2,000 initial direct cost to execute the lease. That $2,000 upfront cash outlay adds directly to the final capitalized value of the right-of-use asset. Because it is paid immediately in cash, it is not owed in the future, so it does not increase the lease liability. Because the payments are made up front, we shift our calculation to an annuity due formula. This generates a new present value of $28,594 for the liability, which we then pair with the total asset value. Any cash paid or incentives received before the lease officially begins will permanently decouple the starting balance of the asset from the liability. Once the initial entry is recorded, the liability and the asset decay at different speeds using completely different mathematical methods. The lease liability behaves exactly like a loan. It strictly uses the effective interest method, growing via the interest rate and shrinking whenever a cash payment is applied. The right-of-use asset ignores the interest calculation entirely. It simply depreciates using the straight-line method evenly over the lease term. Based on the methodology used in year 1, pause the video and manually calculate the exact interest expense and ending liability balance for year 2. These are the correct calculations for year 2. Maintaining a strict barrier between the interest growth of the debt and the straight-line decay of the asset ensures each balance accurately reflects its underlying accounting schedule. We can increase the difficulty by removing the implicit interest rate completely and adding a guaranteed residual value at the end of the lease contract. IFRS has a strict hierarchy for discount rates. You always use the implicit rate if it is known. If it is unknown, the lessee must use their own incremental borrowing rate to discount the cash flows. To account for the guaranteed residual value, you take that final amount and discount it back to day 0 using the present value of a single sum. You add that figure to the annuity to define the new total lease liability. No matter how complex a lease looks, establishing the liability always reduces to combining standard present value blocks like annuities and single sums, discounted at a single allowable rate. For the year 1 end-of-year journal entry, we capture all calculations at once, debiting interest expense, lease liability, and depreciation expense, and crediting cash and accumulated depreciation. These simultaneous entries reduce the asset and liability carrying amounts, ensuring the balance sheet remains in perfect equilibrium. To summarize, these are the 3 core principles for your exam. 1. The asset equals the present value plus direct costs minus incentives. 2. Always prioritize the implicit rate over the incremental rate. And 3. The liability follows the interest method, while the asset depreciates on a straight line.